Good morning. My name is Roy Eitrecht, and I'm going to be your facilitator today on the Wilson County Library Seminar. This is an online seminar, and we're going to be doing lesson number 6. Okay, good morning. We're back now in the classroom on the library, Wilson County Library. And remember that this is an online seminar. As we've mentioned before, you already should know this by memory. It's a weekly seminar that we offer. This is the 2021 Floresville Wilson County Library Seminar. And with that, we're going to move into our classroom. And let's see what we got for us today. This is going to be lesson number 6. Lesson number 6 is going to cover charts. We're using over here the Crux company, and you can tell this is a trend. Over here we see that this thing is moving up, up, up and away. It came down here, only we have one little red spinning top in here, and this is cover a whole year. This is from one full month in here. So this is a monthly chart, as we can see right here. And what we're going to study is this particular bar over here, this candlestick for now. So let's take a look at this right quick. As you notice, this is a weekly chart. It's the same amount of time on it, 1 year. But in a weekly, we see more noise. We call it noise because you will see more red marks, more candlesticks that are red up and down. And when you do it monthly, you don't see that. You see very few. So this is why we want to go through different measurements, monthly, weekly, daily, and by the minute, so you can see the difference and how the chart behave. So this is a weekly chart. We're going to have 52 bars or so in there, right, for every week of the year. And as you can see, we see a little bit different than what it normally you will see in a monthly. Okay, so here we're back again on the monthly one, and we're going to see that this one, it covers a little more history here. This covers 2 years. Seems like, yeah, this monthly, 2 years monthly. So seems like the company did have copper 3 months on the previous year that was very bad, and then it took off again. So with that, we're going to study this part here. We're going to see that this is a daily chart for the 2 years, and now you see a whole lot of noise, and it even makes it very difficult to understand, to see what's happening. And this is just to give you a view. So let's see over here, right? We're going to have more time in here again, and we see all this kind of messy on the daily stuff. This is by the minute. We have a 240 minutes. This is like a 60, 120 yet. This is a 4-hour chart for a long period of time. This is for a year. And of course, here what we're interested in. We're going to look at this particular bar here, okay? It's just this one and only that one. And this is where we're really going to start. So on this day, this bar, as we can see, it covered this much territory. So we want to see if they open right here. When it opens, when it closes, the high and the low of the day. Of course, we don't know when this really happened, but we're going to start from this point on to understand how the chart is developed. So in the morning here, the full bar now, 1 day. This is 1 day. It's a daily chart for 1 day. So it's going to show us this bar. Well, it tells us that the high, it was this one over here. It's going to tell us that over here, this is the low. It's going to tell us that it opened right here. This is where the stock opened in the morning. And then it closed over here. But during the day, it went this low and it went this high. So on the total movement, we got over here that the high and the low is $3.78, but it's more than that, you know. So we can tell here that this at this point we were at 78. The stock was at $78, and at this point over here was 74, right? So we got a $4 move in here, and actually all it took is from here 76 to 76.72. So the total movement, it covered more than what actually happened. So we got $1.16, you know, on the movement, but actually the stock moved from 74 to 78. $3.74 was the total movement of the day. But if you are a regular investor and you use a daily chart, all you're going to see is the open and the close, and you're going to say that the price from the previous day only changed $1.16, as we can say here. Now for the day trader, that's a different information. For the day trader, he loved this because there was $3.74, and he had managed using a minute chart to capture this. He would have somehow, he needed to capture it depending on the time what happened to the high, or he could have cut it here and end here. So we don't know exactly what really happened. Let's look over here now. We're going to see two different bars, right? And what we're looking at over here, this here, and we see how you can compare to the other one, and so on. Now we get into this one here, and here we are again, and this is a 2-hour chart, and the previous one was a 4-hour chart. So even so, this is the same stock, and at the same time we divided now into 4 hours. So in the first 4 hours, it opened here, it went this high, it went this low, and at the end of the first 4 hours, it closed right here, about 77.10. Alrighty, then on the next 4 hours, it opened, but it opened low, that's where it closed. And then it went higher, so at one time the candlestick was green, right? It was higher than the previous close. Then it went higher, so it was much greener. But then at the end of the day, at the end of the 4 hours, it had trouble here, and it closed here, so it actually closed below the previous close here, so therefore it's a red candle, you know. And this is by 4 hours, so it's 240 minutes. So now we're going to look at the next one, and now we're going to have it now every 2 hours, right? So here we're still dealing with the same candlestick, this one right here. However, when we look at it in the 2 hours, right? We got 2 hours, so this is 2, 4, 6. We can say 8. You know, there's not really 8 hours trading, but that's when it ended, the time limit here. So we have here that we got 2 hours, and this is what it did, up and down, one red date, and the next one it opened higher than, so it's a green one. It's a green, but the price, it don't change. So you can trade in here, you know, and you can see that there was more price movement than what we actually have during the whole day when we measure from day to day the open and the close. Now we're going to have a 60 minute, right? This is, we're going to make 60 minutes here. So 60 minutes is actually, we got a 60-minute time here, right? And this is what happened. And we go for every 60 minutes, we're going to change. So every hour, we're going to have a different bar. This is one bar, And they come out by 12 o'clock. We already someplace in here by 1 o'clock. By 2 o'clock, we have this. So when the market opened, it was right here. Then by 11 o'clock, 10:30, we're here. Now here by 12. We're here by 12 o'clock in here. Okay, 12 o'clock. There was 11. This one is 1 o'clock coming up, 2 o'clock, and the close was right here. The reason we do this is to show you that there's a movement in price during the day. So now when we take our chart and we're going to break it down into 30 minutes, we got 30 minutes here, we get a better view of what really happened. The market opening here, and we're going to have $3.74 movement during the day between here and here. But when it opened in the morning, on the first 30 minutes, this is what happened. In the next 30 minutes, from 9:30 now, we come over here, and the price went this far down. You could have a day trader that moves from this position, and he buys in here by 10 o'clock or so, 10:30. By 11 o'clock, we are here. And then by 12 o'clock, he could have hit these highs, and then he sells. So the long-term investor, he only going to see the $1.16 move on the stock. But the short-term or the day trader, he see more movement and action. We notice that over here for the time, that it was green, that's what we painted green. But then eventually it closed down here, but even was lower for the day. On the next 30 minutes, it was red at one time, lower than the previous 30 minutes, and then it moved up and it closed right here. The next 30 minutes, it didn't move that much, but it still moved, and it moved from 76 all the way down to 77.10. The following 30 minutes, it took off and probably went this high, the high of the day, right? So the high was 78.08. So this guy could have bought the stock, right in here. Let's say that he bought it at 75.60, 75 to 78. That's $3 move. So he could have bought 100 shares and made $300. If you're a long-term investor, then you share on 100 shares, or you have made it be $116. You are longer term, so there was a $3.74 move on this stock during the day between the high and the low. Some people got in here, others could have got down in here and right it up to here. A short seller will have short the stock here, and then he will have bought back the contract in here, and that's be like normally about 76.20 through 78. So he could have short and make $2, depending how many contracts he did. $2 per share. So he short 100 shares, he will make 200. He short 1,000 shares, he would have made $2,000. So there's a lot of money that changed hand, and this is what we're trying to get across during the day. It all depends if you are a trader, that you are what they call a scalper, you are a day trader that you in for a few minutes and you capture this little swing on the stock when it swings from this point here to this point up here. Or you're a long-term investor, then you don't look at none of this, and all you're going to see it was the $1.16 that the price when it opened and the close. So between here and here was just $1.16 open and close right in here, and this is when it occurred. It closed right in here. When we measure it every 30 minutes, then we see a different story, how much money it actually moves. So it moves $3.74, and you can have capture a profit in between there and sell the stock at any time during the trading hours. So here we see it that this is a 15-minute chart. So this is the same amount of time, and we noticed before, right? It was 30. This is going to be 15 minutes. So we're going to have more bar, and the trader could have done the same thing. You know, he have a better view of this now. If you're a day trader, they give you a better view of the stock. You see that the market opened in the morning, it went down this way, and then it closed, and then come back here, and then we have 1, 2, 3, 4, 5, 6, 7. So by 12 o'clock New York time, the stock has reached. That don't mean that it didn't went higher. At one time it was green also, but at the end of it, it closed down here. On the next, by 12 o'clock in here, you see, this is every 15 minutes. So by 12:15, now it was lower. You sold here, you could have cut this here at 74.70. You will sell here at 76.60, and you will make about $3 something. It went higher, and it went higher at 78, but it didn't hold, and it closed down here. And then the rest of the day came down, it making another 10, and then by the end of the day, we finished right here. So between this opening here, that it opened at this, and it closed here, this is where we got that $1.16. But in between, we have a larger amount of movement on the stock, and day traders take advantage of that. Some of them use 15 minutes, and on one of those they use 15-minute chart, but there could be hours and 4. So we were trying to see which one suits you best for this kind of trading. Here's every 10 minutes. So when we see 10 minutes, we're going to see that there was some 10 minutes with downside, and all of them went up, and then every 10 minutes, but the result is the same. We end up with $1.16. Here it says 5 minutes. You can see more movement also. The guy that trades 5 minutes, you can see coming all the way down here. He had few drop and then went back up, and then the price settled right in here again. From this open to here, we still got $1.16. Now here what happened when you set your chart, and this is what we want to show you here, that how you okay, so when you set up, we use a stock chart. Okay, there are different setups, but you can set it by the minute. You know, you can set your chart. There's a window. They all might have it in different location, and we want to set it by 1 minute, 1 day. We want it daily. We can set the chart weekly, monthly, 4 hours, 2 hours, 1 hour, 30 minutes, 15 minutes, and so on. And this is what you will get displayed on the chart depending on the amount of month or weekly that you have. Over here we had it set up for 5 minutes, and it's obvious that we're looking at 5 minutes in a particular chart for the time. Here we have it now 1 minute, but we're covering how much time? Covering the whole day. You open here at 3:30, same company, and you see now the movement of the stock very, very fuzzy. We call this noise. It got too much noise. We cannot tell where this is going. You know, so you say, you know what? I don't like the 1 minute chart. I would rather have a 5 minute chart, and then you can see that it's much easier to handle and to see how the price of the stock move. So from here we notice now that this is where we started from. all those movements that we saw was based on just one particular day. He said multiple days now. This is a daily chart. Okay, this is daily. It's the same company, but we're also looking for a whole year, and we notice that the stock goes up and down daily, up and down, and it moves on. And this is the same chart. This is the same candlestick that we looked at it before. This long one, this is where it's at, right here. And we know that this day there was a $1.16 movement, but there also was what? Another $3 and something cent movement inside of this part. And if you were a regular investor like this, long term, well, all you care about this and you care about all this movement. You know that you bought it at 68 and now it's 82, $83 or $81, so you have make about 20 bucks per share, and that's all do you interested in. So depend on the interest, that's what we look for. So short term, long term, so this is daily, same thing again, and this is where you put the overlay on your chart. You come up overlay, you can put, there are many of them. You can do so many of them that we will spend days explaining each one of them. What we're going to do on this chart, we're going to put click on the windows of overlay, and the overlay, what I mean is that we're going to put right over the bar charts. So we're going to have a simple moving average, and then we designate what days, how many days we're going to put a 50-day, 10-day, 20, and so on. This is part of the parameter side of the overlay. So we come in here, and for your indicators, there are many indicators, and you have this is very popular, the RSI, you got different ones altogether, money flow, you know, price momentum oscillators and stuff like that for the indicators. We're going to show you what I normally use, and at this time, you know, percentage price oscillator, you can use those two. So right now what we're showing over here for the relative strength, you know, like we have selected that, and then we clicked on it, that's what's going to happen, and a complete overview of it will be here. You know, we have simple moving averages, and by default they fall into 50-day. You can come over here and change the day. The spontaneous moving average is 21-day, simple moving average 200, and simple moving average is 12. We're setting up a chart that we put the percentage price indicator. That's my favorite. You can select anything else. As we know, you can go in this window and put whatever you want to. It's what it works best for you. So you feel comfortable with this, you stay with it. If you don't feel comfortable with it, you can try it and see which ones you like. So here we have the indicators for the PPO. Then you can select where you want it. Do you want it above the chart or you want it below the chart? Here the true strength indicator, we put the volume. Let me tell you something about volume. On the volume we put 40 days, but the chart have another adjustment. We put 40 days because we're superimposing this 40 days average into the volume chart. Then here's the tricky part. You have the stock here. The name of the stock is one. Let's say that. Let's see what it crocs. CROX. Okay. So we want to see how the stock compares to the S&P 500. So what you do when you open the indicator window, that tab, you come up here and put price and erase whatever is in here, right? And it says blank. What you're going to do is put $SPX. And And what it's going to do is that it's going to give you, as you look at the chart, you can see at the same time how the S&P 500 is working. You want to see what the Russell 2000 is doing. You can also place over here on price, open another new window. When you click in here, you got all those indicators in there. You click on price again. Whatever comes here, you erase it and you put IWM. IWM like in Mary. And if you want it below or you want it above, that's your selection where you want those things to show up. And then we're going to show you how the chart really going to look, how you do that. So here we are. We've first selected the price of the stock and we put 50 days. So here the 50-day moving average on the chart. We're still with this 1 year, 2 year chart, right? August, September, 20, 21. So we got a 2 year chart in here. And notice how the price of the stock comes down and touch the 50-day chart and bounce back again. So this is for a long-term investor. Long-term investor, he's interested in this. He's not a day trader. And then notice how every time the price come in here and touch. So what he normally does is, unless the price drop below this average, he don't worry about it. He just let the money ride, and that's exactly what he's doing. Now we're going to come over here and we're going to add the VWAP overlay. Okay, this is very interesting. You don't have to put that one, the VWAP, unless you are a day trader. Day trader use those. We're going to notice that we put it in. It's right there. You can see it on the chart. It's there, but we don't see nothing here. There's a reason for that. This indicator is only for short-term period. So once you pass maybe 1 or 2 weeks chart, this thing will disappear from the chart, even so it's there. We're going to see it later on. It's going to pop in here. But this particular indicator do not measure long term like this one. Here we're measuring the moving average of 50 days, as we mentioned before. And here's the little bar that we had before here, you know, here we go. And this is what we're looking at. The WAP average is only for day traders, and you want to do this when you're dealing with a short period of time, 1 day, 5 minutes, 10 minutes, and so on. So here we go, and here's this where you select it. You put it in there. You don't have to put nothing in the parameter. That take care by himself. So on the selection, you're going to select that. And then, of course, we have this moving average set for 21, 50, simple moving average, and so on, 12. And we're just showing you where you make the adjustment. Remember that every company that produces short deal, it will have that on it, but not exactly like this. So you have to, depending whose service you subscribe, that's what you will make the adjustment. So here we go. So now we added the 12-day moving average, which now it rises very close to the price of the stock. Notice how the stock also rise, and it bounced away from the 12-day moving average. And it also have with 21 days. And many times the price dropped to 21 days and bounced back. It crossed the 21 days, but it don't go beyond the 50, so the investor stay in there. So for our purpose, if you're long-term investor, you don't need these two unless you want to have them in there, but you're going to have more junk in there, right? That's all it is, because you're only interested in the 50-day. But the other guys that do swing trading and few days involved, and they get in when it crosses this, the 21-day, and it's across the 12th day or something, they get out. They just move out. So You can be buying and selling every time they do one of these. Long-term investor, he's not interested in that, so he don't worry about that. He probably use just the 50 days. Over here we got now, they say 50-day moving average. It was selected, which was down here, and we already have set it in there. So this is how the overlay will look with all those in there. And then it comes the 200-day. You put it 200 days, and what happened when we put a 200-day average on the stock, which should be this one right here. When the price is below this line, we say that the stock, and probably the market too, is on a bear market. Anything above the 200-day, we say, oh, we're in a bull market. If the price get close to this and crush beside that, then we say that we are in a bull market, on a bear market. And this is what we got now, the 200-day here. So a long-term investor might carry just the 200. He's gonna get off as soon as close the 50 days, right? But he might carry in there to when he see when he's gonna return and break out again, so he can jump in. So these lines will be much closer to each other when those days comes, and they will happen. Believe me, they will happen. Over here, some people use the MAC. Let me tell you about the MACD. I don't use it. It was very popular in the 70s. Everybody saw that, man, this was the biggest thing. So if you're a new guy in doing this and somebody told you to use the MACD, well, you're welcome to use it, but it's an outdated formula. The true, real day traders, the experts, they don't use it. So we don't put it in here because of that reason. But I just thought I'd mention it to you because a lot of people like the RSI and they like this particular one, the MACD. What we use is a different type here. We're going to look into now that we're going to be using, right, the PPO. That's what we're going to see. Price percentage, right? PPO, price percentage oscillator. Rather than use the MACD, we use this one, and it's a matter of taste, and we happen to put it at the top of the chart. So when we day trading, we look at those more closely. The guy that do long-term investment, he don't have to worry about that. He don't look at it. Oh, he want to make sure that the price don't go below the 50-day average, and he ride the wave. So he bought this stock at $37 a share. And now it's 90.82, so from 37.82 he have made his $30 a share. If he have 1,000 shares, he will have made $32,000. So he don't worry about the little daily stuff. The next thing we're going to look at it is now our Tsi indicator. So the TSI, you're going to select it from here. True strength is coming right here. See, so we already put the price percentage oscillator. Now we're going to put the TSI oscillator. This fill automatically for you, and you want it above, right? So you will click in here and do the same thing. Put it above the chart, and this is where it shows up. PPO, TSI, and it monitored the same trend, but you notice that even the price for the long-term investor, he don't worry about it because you notice that this goes up and down even when it's coming down in here when the price is still going up. So this indicator, you looked at him, but all these numbers get the information come from all these numbers here. It will move up and down. And sometimes it will reflect the actual movement, like in here, it start going up, and then it settle here, and then we get the next hump in here again, so this might become become later on a head and shoulder or something. We don't know at that time. When it happened, we worry about it. And this is how you put these indicators in the chart. So remember that to put the S&P 500 and the Russell 2000, you need to put it here on the price. Now let's say that you want to compare your stock to Facebook for whatever the reason. It's just to show you that you also can compare to another stock. So you press price on it, and whatever coming here, you erase it and you put FB, Facebook, and now we can track how Facebook is tracking. There it is, right down here, Facebook, how Facebook is tracking this stock, how you can compare against it. You know, we know that S&P 500 is going up. We can tell that. So this chart is obvious following this S&P 500. The S&P 500 is also consistent with the Russell 2000. So you're looking at a bigger market here. You know, 500 stock, 2,000 stock here, and then you were to check another stock that you want to compare it. You put price on it, like I show you here. We put the price and put whatever stock you want to follow. Maybe it's one consistent with here, and you just want to make sure that the stock that you're tracking is the leader in the market, or whatever you get involved in it. Okay, so this stock happened to sell merchandise, with they sell a special type of shoes. You can put another shoe company or retail company. You can monitor here, see how business is doing, and that's the purpose of doing that, you know. So these tools are indicator, but a long-term investors, notice how the chart keep on getting compressed, and the distance between the line get closer because we put in more material on it, so we had to give the same room. Nothing has changed. The price will not go below 50 days, so the investor, long-term investor, stay in there. This is a chart that we used to use before. As you notice, we got all kind of stuff there, right? We got the MACD, we got the force, we got a RSI, we got VTX, money flow, RRG, all these different stocks, different indicators. It's too crowded. We even put color, volume, all this mess. It really not worth it. We learned this through experience. We eliminated all that. This is why our charts look much cleaner, because we eliminated all that. As a matter of fact, to print it, you're going to use more ink with that many colors, but you don't need it. It's up to you. Now, let's get to the VWAP overlay. It's a day trading indicator. Okay, it's not here yet, but it's still in the chart. We still got it stuck in here someplace. Okay. Also, day trader use what they call the Heikin-Ashi chart, which is totally different. But the formula, what they use for this, for the Heikin-Ashi, is that they divide the different prices, so the chart will look completely different. You don't care about the formula, but this particular type of candlestick chart, it makes it totally different from what you normally see. So here is the same chart, but now we have crux again, right? And it's measured daily, right? Guess what happened? Now we finally see, right? We finally see the WAP. Here it is, the dotted line, WAP comes up. It shows. Notice that in something longer, because they got more days, it will not show. Even so, it's here. It's part of the deal. This is regular candlestick, and the other one, Heikki Ashi, are this other type. This was created by the Japanese guy. What he means is average. Heikki Ashi charting technique was developed in the 1700s by a Japanese trader called Munisha Homa. Huh, that's a crazy name, but I don't know if I pronounce it right or not. But notice now how you don't see any sticks on the red, and you see that you still can get the spinning top, but normally in a good day is always the upper stick that shows. So it look completely different. Even so, we measure in 1 day, and we're doing it in a 5-minute chart. So day traders, they are by the end of the day, this is the type of chart they use. So every 5 minutes is a 5-minute chart, and that's the type I use. And it takes more noise out of it than the regular one. So let's see how it looks the other way. Okay, so let's compare them. So here's the regular candlestick. We're measuring the same day with the same amount of time, every 5 minutes. 5 minutes here, 5 minutes here. This is just a plain Japanese candlestick, every 5-minute movement. And so we notice here that we got some reds with up and downs. We see a green in there. We see this one. So it's a green movement in here, and then red over here, and then we see this long bar over here coming up like that. The price went up. When we compare these two, the Heikki Ashi candlestick, guess what? We don't see this green one in here that big. We see just this. It measures completely different. The formula take part of the previous day, previous close and open, and then it will give you a different candlestick altogether. So you want to learn the formula, you can take a snapshot of this, and this is how I calculated. They take a quarter of the open of the previous bar plus the close of the previous bar, and then they put that into the price of what you've moved on this bar. So you're not much interested in the formula. If you want to be, go right ahead, but it's already done for you when you plug it into the chart. And all you want to see for the day trader is when he's going to get out. That's all he's interested in. So as long as they keep on trending up, he's going to buy right here at this price, and he's going to get off someplace in here when he turns. Notice now that this PPO and the TSI work much better when we're doing short term. So now it's more consistent with it. And what I mean is average. It was developed by this guy in the 1700s. So we're going to move on, and we're going to have it here one more time to take a look at it. And notice this one right here, that is also red, solid red over here, white, but it's still trending up. And what they do is day traders, he stays in when the price crosses the dotted line, right, from the WAP. When he crosses that line, he gets in, and when the price crosses this line, he gets out. Some people do it a little bit different. I don't do it like that, but it's a good signal that it shows you there which way it's going. It's above the line. So here we got a regular candlestick. So normally the guy will get in here when he crosses here, and as long as the price don't cross this line, he stays in. He stays in there. And we notice it came down, so if he goes in here and he's gonna make a profit between here and here. So he's trying to stay as long as possible. Me, I won't do it like that. If I see two red bars in there, I'll be running out of there very quickly. I already made my money. We try tomorrow again. So here are the two versions of the different type of candlestick, and that's actually what it works out. So we're coming in here. We're gonna do this part here. So here is we got from March and April. This is Apple, and what we're talking about is how head and shoulder form. You notice that this is a shoulder on the left hand side, then it comes in and it drops right here, and then it tried to make, but it don't cover 50% of this little deal here, and then the price drop. This happened recently. This is as far as the 23rd of February of 2021, and some traders worry about gaps. So back in August last year, there was a gap in price, and they believe that eventually the price will drop and it will close that gap. And believe me, a lot of time it happens. Here's a gap right here, right? And it gap up, went down, and finally closed that gap. When the price went down through here, then it continued, and then it went up. There's a small gap here. It also got filled by this one. And of course, we see one coming down. So somewhere down the line, we're going to cover that gap. But for now, there will be traders that worry about that a lot. You know, we're probably going to call this part one. Let's see how much time we have to add to this on it. And then we're gonna deal with channels. We've been through this before. So remember, the longer the channel, you don't buy, you stay put and you wait, because you don't know which one it's gonna break, okay? When the channel is broken, you wait for confirmation, because it might come back down again and keep on and then settle flat again. So it's obvious that this one broke and it's bounced back and developed a trend above the top of the channel, and that's exactly what it did. And then it broke above the channel and it continued up, and now it's about $100. This strip over here coming from a stock that was $11 on one time. It's not important to us. Just to remember that we're going to see a video where you have all this trend. You have seen it before, but we're going to reinforce it here in lesson 6, because it's very important that you follow the trend. Always remember that the trend is your friend. And then when you want to get out or get in, it depends on how you want to set your chart, and that's the important thing on it. So here is Oracle, right? And this is from 2011 all the way down to 2021. This is 10-year history, right? 10-year history. And the stock moved a trend. The trend is up. We got the same charts, right? We got the PPO, we got the TSI. We notice that we don't have the WAP, because this is 10 years stock here that we're tracking. This kind of becoming relevant of what we're doing, but we're following, right, the 50-day average for long-term investors. And notice how the price, again, from a different company, it goes so high and it gets close to that, bounce again, it goes so high. So you as a trader, you can do projection line. You draw this line in here, okay, and then you take this line in the future, right? We gotta wait, and the stock bounce up and down, but it keep on bouncing. It finally hit this high, and now we can establish a line in here. You can draw the line all the way across for years ahead, because believe me, once these trends start, they will continue, and you can project how much it will go. it might don't go through, but you just draw the line anyway and see what happens. So it comes back down here, and then it raised another $10, I think, on the price. It goes from 50 to about 55, 60 here. So you keep on moving it $10 apart. It comes up in here, go down again, it move up, and now it breaks out about this. So now it's 5 more. You have moved to 15. So we expect, and you can track it later if you want to, Oracle. We expect Oracle to continue this trend, and in the future years it's going to be much higher than $65. You can take my word for it. I'm doing this based on experience. At the same time, remember, that a lot of things can happen in between. Nobody have a crystal ball, and no system is perfect, okay? So notice how 10 years of this stock, if you invested here, this stock when it was $20, you could have put 1,000 shares at $20, $20,000, and now you have what? $20,000, and we have moved on 1,000. So now it's 65. You have made about $45,000 on the stock, but there are people that have made millions. You have got the dividend.
Hello people, welcome to our second film on chart analysis. You'll find the material discussed in today's film much easier to digest if you run through it using our charting software, Rumus. In Chart Analysis 1, we looked at support, resistance, trend lines, channel lines, and we explored what a trend really is. We described technical analysis as a science, and we looked at the theory behind it. In this film, we're going to view chart analysis as a subjective skill. We're going to focus on the art in charting. I'm going to take you inside the trader's chart room and look at a selection of chart patterns that crop up time after time. Generations of traders have used these patterns to identify future price movement. These patterns can help you make money. Just a word from the wise though, never underestimate the market. Countless people have spent their lives trying to find a surefire pattern that allows them to predict the market with 100% accuracy. Only very few succeeded. And those that did have only been right for a short period of time, and then the mood of the market moved on, leaving their elaborate systems useless. The fact is though, that the patterns we're going to be looking at today are accepted as the most reliable patterns, and many traders act on their signals. In some ways, what we are doing is exploiting a self-fulfilling prophecy. What we need to do is see what the other players are seeing and learn to read these patterns in order to take the next step. Make sure that you work with patterns that are easy to spot. Just remember that the more traders that can see the pattern, the more predictive that pattern will be. These patterns are traditionally split into two camps: the continuation patterns, which signal that the current trend is going to continue, and the reversal patterns, which signal that the current trend is about to reverse. Let's start off by looking at some signs of reversal. This simple pattern is known as a reversal day. You can find it either at the top or the bottom of the market. Now, it stands to reason that the basic requirement of any reversal pattern is a prior trend. Therefore, the first thing to remember is that each and every reversal pattern needs an uptrend or a downtrend to reverse. This trend can be a major, an intermediate, or a minor trend. And all we need is a trend of some degree. The reversal day follows a typical pattern. On a bull market, it is preceded by a sharp price rise, and the pivotal day sees a bar with the highest maximum and with a closing price lower than the low of the previous bar. So the bar of the reversal completely covers the bar of the preceding day, as you can see here. This pattern crops up pretty frequently on charts, most usually on minor trends. Why minor trends in particular? Simply because sudden price changes are short-term in character. So what should we do if we spot a reversal day? First of all, we should fix our profit. Close any position you have on the preceding trend. It's better to be safe than sorry. And at the bottom of the market, the advice stays the same. Cover yourself, fix your profit. Sometimes the reversal takes place over 2 days, and we call this a 2-day reversal. On an uptrend, prices on the day are rising and achieve a new maximum. Prices close at a point very near to the day's high. The next day sees price closing at the low of the day before, or even lower than it. One point to note is that the wider the price range over the 2 days, the more power the reversal has. The significance of the reversal, whether it's a 1-day or a 2-day, relies heavily on where and when it occurred on the market. You've got to look at the bigger picture. If the market has risen or fallen sharply without any intermediate corrections, or has neared long-established resistance or support levels, then the reversal signal deserves your attention. Sometimes reversals happen as part of a larger and more significant chart pattern. We shall explore these larger chart patterns further. When this happens, the reversal tips us the wink that a more significant pattern is on its way. You know, pretty often, a reversal of a short-term trend happens near a long-term support or resistance trend line. Although we call these patterns 1-day or 2-day reversals, the pattern can be found on charts of any time period. Please bear in mind that the longer the time period, the more significant the reversal. I'm not suggesting that you trade only on monthly charts. What I'm saying is, gauge the value of this pattern with the longer term trend in mind. And if you're looking at a monthly chart and you happen to notice a day reversal pattern on it, then it can give you an idea of the direction of the trend for the next 3 or 4 months or so. And that is going to help you in your daily and intraday work. The next pattern from the chart room that I'd like to take a look at is based on 3 trend lines. It's called the fan principle reversal, and it's an alternative way of using trend lines. You know how when there's a down trend line breakout, price often falls back a little, retesting the old trend line, which is now a support line, and price fails to break through it. So what you do here is plot a new resistance line, which price breaks through to, and then falls back, giving us a new support. you plot a third resistance line, and when price breaks out of this, it usually signals the beginning of a new uptrend. At the top of the market, the breakout of the third fan line signals the beginning of a downtrend. It comes as no surprise that this is called the fan reversal, because the three trend lines look like an open fan. The main thing to remember is that breakout on the third line is a strong signal of trend reversal. Sticking with the theme of trend lines, here's a technique which combines support and resistance lines with correction levels. What you've got here are your speed lines. Cast your minds back to our bit on correction levels in the last film. Do you remember? To plot correction levels, we draw a perpendicular from the trend minimum to the level of the beginning of the movement. We measure off 3 points on this line at 0.382, 0.5 and 0.618. We then plot lines from the beginning of the movement through the correction points. These lines are sometimes known as projected trend lines because before the correction occurs, the lines hang in the air, but once the correction begins, these lines delineate levels of support and resistance. Play around with it on Rumus and you'll see. Here they map out new lines of support and resistance on a correction of an 8-month downtrend of the euro in 2005. You can use speed lines on any time horizon. Just remember, the longer the time period, the stronger the punch and the more potent the reversal. You can plot speed lines without going to the trouble of dropping perpendiculars and the like with Rumus, Forex Club's charting software. All you do is identify the trend line on the chart in pink, drag and drop FIBO-Fan to the trend line, and Rumus will do the rest. Here's a fan I plotted on the Aussie way back in 2002. The lines of the fan continue to give useful information to this day. These lines have a wealth of applications which we'll explore in our film on wave analysis. This pattern is called head and shoulders. It's not to be confused with a medicated shampoo, I might add. The pattern is a great favourite with traders and was identified way before the appearance of the shampoo. Why they called it head and shoulders is obvious. The large peak in the middle is the head, while the two flanking peaks are the shoulders. It's not only a very important pattern in its own right, it's also the key to the other reversal patterns. If you can work well with head and shoulders, you'll easily cope with the rest. In fact, most of the other reversal patterns are mere variations of head and shoulders and therefore will not need an in-depth explanation. The reversal patterns reflect the play of forces that produce trends on the market. Remember the three groups of traders in the story in Chart Analysis 1? In our first film on chart analysis, we saw how useful it was to plot lines on our charts. Lines like support and resistance, channel lines and trend lines. We'll continue with this now that we're dealing with patterns. Learning to plot these lines will significantly improve the returns on our trading. Let's consider what's happening on the market while head and shoulders is forming. We start off with an existing uptrend, that is consistently rising maximums and minimums. Price then decelerates and falters, just as we saw with the fan reversal, and the trend flattens. At this moment, The forces of supply and demand are in balance. At the end of this phase, price breaks through the flatter support and a new trend, a downtrend, begins. This support line is known as the neckline. Sometimes the neckline can be plotted immediately after the left shoulder has taken shape, but usually we need to see the head before we can plot the neckline with confidence. More often than not, the right shoulder is similar in appearance to the left. This repetition of shape and patterns is the key to chart analysis. It enables us to use price history to understand its likely future.
For monthly stock, and notice how it's coming up, and we got the same deal. Notice how the S&P 500 is moving up, and at this time, well, we gonna stop on lesson number 6, and we're gonna make this part 1 of lesson number 6. We will continue with part 2 on the next session. On the next section, we'll be talking about stocks, and we're going to be measuring them by a minute. That's probably going to apply more to day traders and people that deal during the day on a movement of the price, and then they close their position the same day within 1 hour, 2 hours, or during the day before the end of the day. A day trader, this is what they call a day trader because he never stay overnight. He believes that overnight things can happen where the price of the stock can drop dramatically, so he's not interested in long-term investment. So we're going to cover that on part 2 of lesson 6. Okay, good morning. We're back again with part 2 of lesson 6, and remember we stopped on the last session with Etsy. We noted that the stock is about $220, and this is a monthly chart. So it shows you how they're coming around from 40 to 200. This is an opportunity of people that invested on these stocks when it was $20, $40, and they have made $160 in a matter of 1 year. So this is going almost 400% up. Let's see how Etsy works out for day traders. So with that, we're going to look at Etsy way back. Etsy when it was back a year ago, it continued moving from the 40s from the $40 up to here. So notice that it was a channel, right? Remember what I told you about channels on the other one? There's a channel in here, and this channel has produced eventually a breakout, and the longer the channel, the higher it will go, and that's exactly what had happened. The price of the stock had gone climb and don't see no end. In less than we could say a year had gone up from $40 to $240. So that's about $200 gain, 200 gain in there. So let's see how a day trader could use Etsy to make some money. Okay. Okay, here's a daily chart. You notice that we have over here the WP, and it's a 15-minute chart. This is looking at a 15-minute, how the price moves in 15 minutes. So we also have how many days? We got 1, 2, 3 days, and this is the third day here. So this makes it the 26th of February of 2021. In the morning at 9:30 in the morning when the market opened, it broke up. It was down here. This is what closed before. It closed like probably about 195 over here. And when it opened in the morning, it jumped up here to 225. $30 move, right? And then in the next 15 minutes, it goes down. By 9:30 in New York time, we're now to 210, right? $210. But now it comes over here, start moving up, and the 210 now it's at 225. So it had moved $15 from here to here. A day trader like this because he don't stay all day on it, and he can make $15 a share. So if he have 1,000 shares, but normally the other people buy millions of shares. Believe me, there are millions of shares traded. If you notice here that on the first opening, on the first 15 minutes, they traded over 1 million shares. So a guy buying 1,000 shares, he's, no problem. But what we have to see here is that depending how the day trader operates, he buys here, he moved here, he made 15, he got 1,000 shares, he made $15,000. You think he's gonna stay there and wait? He's gonna sell right here, and this is what happens. Some of these guys made the money, start selling and drive the price down, and now we're back to 215 over here, $5 shy of that. Most of the sellers are gone. Look at the volume down here. There's not too many people active. And then at the very end of the day, you see, guess what happened? Price increase, right? Are we having more sellers? Because one time it went up, so apparently somebody's selling also. Notice also here the S&P 500. The S&P 500, it being kind of flat. It goes down flat, but the S&P 500 not going up. So all those things affect the price of the stock. We come over here now to the following day, right? So we were now on the 26th. On the 26th, we're coming into March 1st, which is not there yet. Yeah. So what it will do on March 1st, we don't know. But just look at it, how it goes down, and this is trading for 5 minutes. And this day trader here, right? He could have see this part here. He's gonna buy the stock, right? He's gonna sell short the stock here, or he's gonna buy an option, a put. The guy over here can also buy a call. So many contracts on a call and ride the movement of $10, $15. Over here we go from 205 to 200, and eventually we end up at 195. So you got a $10 move with some rise on it. A trader can sell the stock short over here and buy it back over here to make his $10. He can buy an option also and sell it over here. He might do that again here, or he might stay for the whole trend because the trend is down today. You can tell that the price is going down, and this will happen. On the 26th is a different story. Now it breaks out, and price goes up. So this is normally what the day trader do. We have it now here with 10-minute chart. 10 minutes, a 10-minute chart look a little bit different, and it's easy to see. We still get the same, but we don't have as many red bars, candlestick, because they gotta sort through the 10 minutes. So 5 minutes, you see a red mark, a red candlestick, don't panic because it might turn into a green one, right? Here we go now, and we have 15-minute chart, so we're going to see less red and less green because over here the initial drop, it went down this far anyway, but we're going to only see two marks for the drop. Then on the next one, see next one, and then goes up again, but we're still having the same thing. So okay, so with that, my friend, I'm going to tell you that we be going into the end of the class. As you can see here, thank you for being here today, folks, and we see you all next time. Remember, we're here to mentor you, give you direction, training, and support so you can get motivated and achieve your goal. We want you to be successful when you take this seminar. Thank you for your time, and we'll see you on lesson 7 next time.